Okay, it looks like most people are signed in, so we're going to go ahead and get started. Welcome to Planning for the Future, Balancing YOLO and Saving for a Rainy Day. My name is Claudia Cabrero. I'm an executive committee member of the Young Alumni Network, and I'm looking forward to hearing from today's incredible speaker along with all of you. Before we get started, I want to remind you of some quick housekeeping guidelines. Participants' microphones will be disabled during the presentation. If the speaker asks for participation or if you have a question during the Q&A portion, please unmute yourself. We recommend that you use speaker view today for best results, not gallery view. And we've scheduled a time for your questions and answers after the presentation, but please feel free to drop your questions in the chat box in the meantime, and I'll make sure that it gets to the speaker. If you need any help at any time, please message the meeting host through the chat box for assistance. Without further ado, I'm happy to introduce our presenter, Francisco Mantilla. Francisco Mantilla is a financial advisor for Edward Jones with years of experience in wealth and financial strategies, investment advice, retirement planning, and college education investment plans. He was born in Long Island, New York, from Ecuadorian parents, and Francisco moved to Miami at 12 years old and obtained his bachelor's degree from FIU. He has a master's in business administration from Nova Southeastern University. Francisco's inspiration to help others stems from his family's background, with goals to help his clients build a customized retirement and financial service plans. He's inspired by the dedication of recent FIU grads and hopes to network, advise, and build long-lasting relationships with young FIU alumni. On his free time, Francisco enjoys spending quality time with his wife and their young son. Francisco, without further ado, I'll let you take it away.
Thank you. Good afternoon, everybody. Thank you for that introduction, Claudia. Again, my name is Francisco Mantilla. It's great to be here with everyone today. I'm a financial advisor with Edward Jones. My office is located in Plantation, Florida. I've worked for Edward Jones for about 3 years now, and I have lived in the community for over 25 years. I became a financial advisor because I have a passion for investing and helping people meet their financial needs. This is also a big reason why I came here to present for you guys today, to help people like yourself become more of an educated investor. The part of my job I enjoy the most is helping my clients meet their financial needs. It's an opportunity to change lives. To accomplish that, I have to truly know my clients and understand their financial needs. So today, our presentation is just about foundation of investing. We're going to keep it simple, so let's get it started. All right. At Edward Jones, we have an established process, and that process is around your financial needs. So right in the middle of that circle is my financial needs. We have the 5 steps that we use for every single person that we sit and speak to. So the first step is to ensure we understand what's most important to you. Only then can you and I work together to build your personalized strategies and the specific actions needed to help achieve your financial goals. We'll continue to partner with you and your family over time, revisit your goals and risk tolerance, as well as those strategies we develop to keep you on track towards your goals. The path that I mapped out on this slide is only one strategy to help you reach your long-term goals. Let's go to the next one right here. Okay. So I think a great place to start our discussion about the foundations of investing is to answer the question, why do I invest? The answer to that question will be unique to each of you, but your answer to that one question, why, is the foundation for the investment strategy that is uniquely yours. The answer to why will help you better understand the strategy behind the how. Today, we'll discuss 5 basic rules to form a strong foundation for investing. As you see here, the rules are: develop a strategy, stick with quality, diversify, invest for the long term, and finally, focus on what you can control. There are a number of tools to consider as you develop your overall strategy, but understanding the foundation of investing, you'll better be equipped to choose these tools wisely. For instance, if you have a 401k or 403 employer-sponsored plan, your employer might be able to match you 3 to 6% depending on the plan. Now, I always sit with someone and say, this is the first tool to investing for yourself in your retirement. Now, think about this question I'm about to ask. If you go to your bank, Chase, Wells Fargo, SunTrust, whatever it is, and you go to the teller and the teller says, hey, we're running a promotion this month. For every $100 we're going to give you, we're going to match it and put it into your account. Who would say no to that? So that's what your employers are telling you. If they match your 3% or your contributions for the year, that is free money. Don't leave that on the table. However, when it comes to your retirement, you may want to invest beyond your employer-sponsored plan, or you may have some savings goals outside of retirement. For instance, education or being prepared for emergencies. In this case, you may be wondering, how do I get started? Most individual investors make their money over time, not overnight. While their strategies may differ based on their personal needs, the successful investors we've known seem to follow the same set of guidelines as our rules for investing. As often the case in life, the rules are simple, but not always easy to follow. So we'll review some of these rules now, so you may consider them as you make investment decisions that will impact you and your family. Okay, rule number 1, let's develop a strategy. Your investment strategy should be determined by your long-term goals, investing time frame and risk tolerance. Some of you may have a goal to pay for your child's education 10 years from now. You also may be thinking about your retirement. It can be very difficult to stay focused on your long-term goals when there's temporary market declines, or you might find it hard to say no to a new investment that may be popular temporarily. As you make investment decisions, your strategy will help you stay focused on the long term, so it will be easier for you to stay on track to achieve your long-term goals. A good example is COVID. If many of you realized in February and March, very bad times in the market that rattled a lot of investors. But understanding your risk tolerance is key to developing your strategy. So risk tolerance refers to your willingness or comfort level with taking risk. How is that level determined? Typically, you'll be asked to complete a questionnaire that's used to gauge how you might react to risk in different situations. Gauging risk tolerance and your potential behavior is important because it's most likely you'll reach your long-term goals if you don't abandon your strategies, despite short-term market volatility. By finding the right balance between the risk you're willing to accept and the returns you anticipate reviewing, you'll be in a better position to stick with your investment strategies, regardless of what the market is doing. So let's move on to rule number 2. Let's talk about quality. Okay, so as I mentioned early, if you get any tips on today's hot investments, the best advice that I can offer you right now is ignore it. At Edward Jones, we're not big on investment fads such as real estate or gold. When it comes to quality, it can be difficult to distinguish one investment from the other. For instance, with more than 65,000 stocks available to trade globally, it can be difficult to choose the right one for your portfolio. At Edward Jones, we filter stocks based on geographically, longevity, size, and quality. From that group, we further narrow the field by identifying companies we believe have sustainable competitive advantages, experienced management teams, and strong financial positions. Last, we use an analysis to determine a fair market price for that stock. This process allows us to recommend what we believe are quality companies with attractive stock prices. For example, you might have heard the fad of Bitcoin, the marijuana stocks. That's not something that we are invested in. We don't see a long-term position in those type of, for right now. In much the same way, bond quality is important, considering when it comes to your investments. When buying bonds, don't be tempted by lower quality bonds paying higher rates. Along with those higher rates come increased risk that these bonds will fail to make interest payments. So let's move on to speaking about diversification. So no single investment platform performs well under all conditions. If a large portion of your portfolio is concentrated in one type of investment and bad news causes its value to drop exponentially, your long-term financial security may be in jeopardy. It's important to remember that diversification won't guarantee you'll make a profit or keep you from losing money. Investing does not have guarantees. But as I said, diversification can help you reduce your risk. There's several layers to diversification. One is asset allocation, which means dividing your money amongst different asset classes, such as stocks, bonds, and cash. In fact, allocating your investment effectively is the single best step you can take to improving your return potential. A major study of the factors that determine financial returns showed that over 90% of the variability of returns is determined by how you allocate your assets. This means the difference between your returns from year to year is largely related to your asset allocation. As a result, asset allocation has a much bigger impact on your investment success than efforts to time the market by buying and selling different stocks at a different time. Asset allocation is also more important than the types of investments you choose. To help you illustrate this, we have this investment period which shows different categories. We have cash, income, growth and income, and growth and aggressive. At the lowest level of the pyramid are cash and cash equivalents, such as savings accounts, CDs, bonds. If you keep your money in a savings account, which typically have lower rates, you most likely won't earn a lot of money on that. The next level is income, such as CDs, bonds. These investments generally have lower risk, lower growth potential, but overall can reduce the risk of your portfolio. Stocks fall into the upper portion of the pyramid. The higher you go on the pyramid, the more risk level increases. However, it also means the potential for greater returns. Historically, the average inflation rate is about 3%. So at that rate, the cost of goods and services could double every 25 years. All right, diversification. Let's go to the next slide. When you hear about diversification in your portfolio, that means owning a variety of investment types and not being over-concentrated in any type of investment based on your risk tolerance and your portfolio objective. For example, let's look at the type of investments. Let's look at bonds. Bonds are debt securities similar to an IOU. When you purchase a bond, you lend money to a company, municipality, state, or the US government to finance a variety of projects and activities. Basically, you as the investor lend your money to the issuer, and the issuer agrees to pay the money back at a specific time in the future. Your choices generally range from 1 day to short-term investments, such as bonds that could mature in 30 days. In general, the longer the maturity, the higher the rate. Longer-term bond tends to fluctuate more than the shorter-term bonds. Let's go to the next slide. Okay, so many people associate investing with the stock market. So what does investing in the stock market mean to you? You may have heard of bull and bear markets. The use of bull and bear is to describe the markets come from the way the animals attack their opponents. A bull thrusts his horns up in the air while a bear swipes his paws down. These actions are metaphors for the movement of the market. If the trend is up, it's a bull market. If the trend is down, it's a bear market. When you invest in the stock market, you are buying into a publicly traded company. What are the ways you can earn money in investing in stocks? Most people invest in the stock market. You can earn a rate of return. Two ways that you can do this is the potential growth of principal, and also known as capital appreciation, and dividends. Traditionally, some quality investments you can make dividend paying stocks. They're usually the stocks of well-running companies constantly strong earnings, and these companies seek to reward their investors. Recently in the news, you can see that Apple and Tesla did a stock split. What does that mean? It's rewarding their current investors by giving them more shares. The value of the shares do not change, but they're getting more shares for what they own right now in those companies. And of course, stock dividends can be an additional source of income for you, but dividend paying stocks offer more than income. They also have potential of growth. As you can see, stocks are historically paid dividends. Typically, higher quality stocks outperform stocks that don't pay dividends, shown in the blue. Of course, you can also diversify your equities or stocks by sector. Stock market returns of different sectors can fluctuate. If you diversified, those fluctuations may not affect your portfolio as much. Let's review an example on why it's important to diversify. The technology sector is a good example. That sector had tremendous growth in the early 1980s, but then slumped with a slowdown in the personal computer business and mainframe markets. In the mid 1990s, however, there was a major advance in microprocessing technology that gave the personal computer business a big boost. Investors returned to tech stocks. Then the slowing economy of 2000, 2001 adversely affected technology, and tech stocks prices dropped again. After all these investments were in, if all of your investments were in tech, you would have had ridden a roller coaster. If you had some in tech and some in other sectors, energy, for example, your portfolio would have been a little more stable. So we've talked about bonds, we've covered the stock market. Next, we'll discuss packaged investments, which include mutual funds, ETFs, and unit investment trusts, other similar types of investments. So let's get started understanding what a packaged investment is. Packaged investments such as mutual funds, exchange traded funds, and unit traded funds invest in a variety of stocks and bonds in a combination of two. So you can receive built-in diversification. When you invest in one of these, your money is pooled with that of other investors. For today's purpose, we'll focus on mutual funds as an example. A professional money manager or money management team that invests the money into a variety of securities to help to fund meets its stated objectives, such as growth or income. So what are some of the benefits of investing in a mutual fund? Unlike many of other investments, mutual funds can be appropriate investments for larger or smaller sums. Here are some other aspects of mutual funds. Diversification. Most funds diversify their holdings by buying a wide variety of investments that correspond to their category. A typical stock fund, for example, might own stock in 100 or other companies providing a wide range of different products and services. The advantage of diversification is that losses on some stocks can often be gained by others. You can further diversify your portfolio by investing in multiple mutual funds. However, please note that diversification does not guarantee a profit or protect you from losses. All right. So what are other ways you can earn money from investing in a mutual fund? If you're in the bond market and in a bond mutual fund, it earns interest. Just like any other bonds, it will pay you on a monthly basis your dividends. The second way is price per share of the mutual fund increases in value. When a mutual fund management sells a security within the fund at a profit, a capital gain is realized. Any gains are periodically paid to fund shareholders in capital gain distributions. So you've heard me use the word risk a few times during this talk. You are all probably aware that most of these investments carry a risk. Mutual funds carry their own risk. These risks may depend, depending on the type of investment, but some general principles do apply. The stocks and bonds owned by a mutual fund may fluctuate in value because of market conditions. causing the value of the share price to fluctuate. Okay, rule number 4. All right, remember your strategy needs to help provide for not only you and your family's goals today, but it also needs your goals 25 years from now. So many things can change from year to year. That's why it's important you talk regularly with your financial advisor to make sure your needs are being met, and if necessary, adjustments to help ensure they are. Regular investment reviews are also a good opportunity to make sure your beneficiary designations are up to par too. Over the past 84 years, the US has experienced war as well as economic and political uncertainty. In spite of these setbacks, our nation and our financial markets have preserved. Even during the 1930s, which was one of the worst decades for stocks, the stock market basically broke even. In fact, in 2009 marked the end of one of the most worst decades ever as stocks fell an annualized 1%, second only to the decade ending in 2008. However, a difficult 10-year period has historically been followed by strong performance, 13.1% on an average per year. And of course, past performance of the market do not guarantee that it will perform that way in the future. All right, next. So, type of investments, we're going to look at systematically investing versus lump sum investing. Lump sum investment, for example, is if you have $1,000 and you put it into the stock market. Systematically investing is investing over time. You may need to rebalance or make some minor changes to take advantage of opportunities, but it's unlikely you would need to rework everything in response to the market changes. Let me give you an example on the two. So the lump sum investment strategy producing, if you were to deposit, let's see. Sorry. Okay, so the charts right here have a potential decrease in average price paid per share if an investor deposited $5,000 as a lump sum, and over time he paid $417 on a monthly basis deposits. He ended up with more shares over time than the lump sum investment. So again, this is the same thing as your 401k. 401ks, you deposit every 2 weeks or every time you get paid. Systematic versus lump sum. Let's go ahead and go to rule number 5. Okay. So rule number 5, plan, budget, review. You can't control the economy, but what you can control is your saving and your spending habits. So you're more prepared for that rainy day. While not the most attractive word, budgeting can highlight while your spending and always increases in your savings. It's always important to establish an emergency fund. Rule of thumb with Edward Jones, 6 months worth of living expenses to guard against unexpected expenses, job losses, and general recommendation. Additionally, you can control your level of debt. Some debt is necessary part of your financial picture. For example, in education, a car, or a home. That would not be possible without borrowing. On the other hand, credit card debt can cause financial problems if not managed appropriately. You can't control the stock market, but you can control the way you respond when the stock market drops. All right, let me see that page. All right, so let's go to the next slide. So we covered a lot today in a short amount of time, but I would like to recap what I presented today and collect our thoughts. Rule number 1, you develop a strategy. You have to assign a goal to what you're trying to do with your either retirement or your cash that you have in hand. Stick with quality. You know, if someone comes to you and says, I have this stock idea that will make you a lot of money in a short amount of time, don't listen to them. Stick with quality. Diversify. Everyone's heard the saying, don't put all your eggs in one basket. Same thing with your investments. Invest for the long term. It's hard to say, but think about right now, 10 years from now, how happy would you be if you were to invest in Apple, Microsoft? Now do the opposite. Would you have invested in Apple and Microsoft 10 years ago? Think about the long term. And number 5, focus on what you can control. The market is going to do what the market does. Don't react to the market. That's one thing that you cannot control. Level of debt, budgeting. That is what you can control. All right. Next. All right, so at this time, I would like to open the floor to any questions, if you have any.
Thank you so much, Francisco. I think that was very useful information for our participants. We now have about 15 minutes to answer some of the questions that we received in the chat. So I'm going to go ahead and pass them along to you. The first question this morning was from, give me one second, I'm sorry. We had a question from Daniel, and he asks, how can you find a good mutual fund to invest in?
Okay, great question. So there is a lot of mutual funds out there, okay? And they're not all created equally. And the way I explain a mutual fund, and think about when you were in school, each mutual fund gets graded, A, B, C, and D, but their grades go by 1, 3, and 10-year performances, okay? There's a way of filtering out, and this is my job, of filtering out all the mutual funds that are not performing at the best rate possible. So honestly, get with a financial advisor. He can help you. Send me an email. I can tell you how I analyze all mutual funds, but be careful when you get into a mutual fund because they're not all created equally.
Thank you, Francisco. We had another question from Arvind. It says, recently there has been interest in the stock market with the COVID turn down. What is your advice to anyone who is new in the market, such as Robinhood investors?
So Robinhood investors has been a topic at Edward Jones for a bit now. It's a great way to start buying into these companies. You don't pay any fees. You buy into these great companies that Microsoft, Tesla. If you're thinking about using Robinhood and getting into the market, it's a great way. But again, stick with quality. You know, I hear so many times that, you know, at one point people were buying into gas and they didn't know what they were buying into. It wasn't even gas. So stick with quality companies. Think of a company that you are going to be happy that you own 10 years from now. Innovative companies. Tesla's amazing. Microsoft, Apple. These are all great companies. 10 years from now, how happy would you be if you own a couple of shares of those companies?
Thank you for that. I had another question from Jimmy. Jimmy says, as a young professional, what are the most essential steps for him to implement in the next 6 months to start building his financial future?
I would say, and this is personal for everyone. Money is a very personal issue. So look at your finances. Look where you are today as far as your retirement. Time flies. I remember when I was just in middle school, and now, you know, I'm here talking to you guys. And one thing I would tell my younger self is I would have started investing a lot earlier. Okay? If you have that 401k, that match, or you have, you know, an extra amount of money, put it into the market if you don't need it. In the next 6 months, it's hard to answer because I think 5-10 years from now. Those are my thought processes. But if you can look at yourself and sit down, again, do your budget, see what you can control. Level of debt. Those are things that you are going to be so happy for in about a couple of years that you don't have any of that and you have some savings. Financial security is huge.
Thank you, Francisco. So when you have an employer-sponsored 401k, normally the money for the 401k, if you choose to, comes directly out of your paycheck. And so then your money basically never makes it to your bank account and it gets put into your 401k. But For someone who may not have an employer-sponsored 401k, or their employer does not offer any sort of investments or retirement strategy, is that something that someone like you could help with? And what would be the steps to get that started?
Sure. So if you're an entrepreneur and you don't have the 401k option, there is what's called a SEP IRA, self-employed IRA. Works the same exact way. And I love working with entrepreneurs. You have to take advantage of what the IRS has out there for you. Why not put away tax deferred income by also lowering your income for the year as an employee? That's huge. So I love working with entrepreneurs. A lot of information I can give them. Reach out to me. I love speaking to anyone that will listen.
I'm going to give you a little bit of a task, because you've provided, or you've offered a couple of resources, but I think many of us here do not have your contact information yet. If you don't mind, if you can put that into the chat while I ask you the next question. Rebecca wants to know about investment apps like Acorns or Stash. Do you recommend them for getting started with small investments?
I do, but again, follow the rules. Don't get involved in these high risk things. Don't listen to your friends about what's going on with these investment fads, Bitcoin and everything. Like I said, stick with quality, stick to a plan. I definitely would get involved. Robinhood, you don't pay any fees. You just pay for your stock. I would definitely start with that. But the best thing to do is stick with quality, for sure.
Arvind also wants to know, what are your feelings about stock options? You can make money fast, but lose money fast as well. Is it something you avoid altogether because of volatility? There's an age-old debate between Roth and traditional IRAs, and which one do you think is better for someone that is maybe about 30 years away from retirement?
Okay, so I'll answer the first about options. So options are very, very tricky. It's something that you can make a lot of money, yes, but then you can also lose a lot of money. We don't do that at Edward Jones for a couple of reasons, where we stick with our plan. If that's something that someone would get into, again, it's very volatile. I would definitely, you need to know what you're doing. And you said the difference between traditional and Roth?
Correct.
Okay, so when you retire, I always joke about this with everyone I speak to. Basically, another word for retirement is unemployment. You're not working anymore. You don't have the will to work, or you just can't work anymore. So there's different vehicles that you can set up to help yourself financially when you are of age. You start with your 401k. Again, can't stress that enough. Start putting away there. You won't see that money until you're 59 and a half. You can also start a traditional IRA. You can also start a Roth. Okay, so the Roth is a different bucket that you can take from when you're in retirement. There comes strategies where if you have too much money and you've made too much money in the stock market, after a certain age, you reach a certain tax bracket. If my clients reach that bracket, they have the Roth to take out for tax-free, so they have money for the rest of the year. So it's just another bucket of tax-free income that you can take from in retirement. If you can do it, I definitely, it's a good option.
Thanks, Francisco. Laura is asking, how important do you think buying stocks based on the company's value is?
It's extremely important. So right now, a lot of my calls are based on evaluating these companies. So you see Amazon, you see Tesla, you see Apple, and you see Microsoft, all-time highs. Where can they go from here? These calls are based on looking at what forward thinking for the next 2 to 3 years. Tesla's price is extremely high, but it's still undervalued as a company. It's still a great time to buy into that company. Same thing for Microsoft. They have so much implications with their cloud-based that they're going to start offering different services. Microsoft Teams, who here does not use that on, if your work uses Microsoft Teams, it's a great platform, and everyone's majority are working from home. So it all, again, it all depends on the evaluation of the company. Edward Jones gives me a very nice, they give me nice tools for me to do that, and I pass that information on to my clients.
Perfect. Quick clarification, Gabriela's asking, I'm sorry, back to traditional versus Roth IRA. Which one do you recommend that we begin with?
So to begin with, it's always traditional because that's pre-tax, okay? So it's, you're deferring the tax till when you take the money out when you're 59 and a half. So yes, definitely start with traditional.
I know that Francisco and I have actually talked about this before, because when I first graduated and was looking at my different options for balancing YOLO and my rainy day, I had, I guess, a misconception that you needed to have like this huge savings account to talk to someone like Francisco. So Francisco, can you tell us a little bit more about, at what point is someone ready to speak to someone like you? Maybe, we started off doing Robinhood or one of those apps, and then now, once we've done that, at what point really should we be talking to someone like you to help get a full picture of where we are and what you or someone like you could do to help us?
So I always say a conversation doesn't cost anything. Conversation is complimentary. I would love to speak to anyone that has questions about this. The one thing that, the best thing about having a conversation is, if I plant a small seed in your head about investing, 10 years from now, and again, I'm thinking 10, 15 years from now, I really hope that, you'll look back and say, all right, that was probably one of the best things I've ever done. So it doesn't cost to have a conversation. I'll do complimentary financial reviews. I can tell you exactly where you are, how to help. That's not a problem.
Perfect. I have another question coming from Vera. She said, how do we balance student loan debt with savings?
Student loans, yes, Sally Mang. Debt. So again, that is something, when you buy a home and when you buy a car, those are things that we borrow for. One thing that I would say is, make that push to pay off your debt. Don't think temporarily for this year. Think 5-10 years from now that you don't have that debt anymore. Now you have more disposable income, okay? You have more disposable income. You don't have this debt. You're gonna be in a lot better position to start, either investing or saving for your retirement. But you can balance it out. Again, nobody likes the word budget. You gotta create one.
Thank you, Francisco. I have someone, I'm sorry, Rebecca was asking, if you're brand new to buying stocks, what are the basic ways to get started?
Okay, so again, if you go to Robinhood or all these platforms, Fidelity, they do have a majority of mutual funds and ETFs. If you look at an ETF that mimics the S&P 500 or the NASDAQ, you're basically buying into that specific index. Depending on how much you have, or kind of just to get a feel for it, you're diversifying within that index. This is my rule of thumb, and and actually I got it from Warren Buffett. Just think of a company 5-10 years from now that you're going to be happy that you held, and buy into that. Look at your phone. What kind of phone do you have? What kind of computer are you on? What are you using in your everyday life? Look into that.
So then, Francisco, you would still advise investing in the long term in companies like Apple, Facebook, Tesla, even though they're all at an all-time high right now?
Don't try to time the market. Don't try to time the market. No one does that, okay? If you're thinking forward, think of your time horizon, okay? I have a 4-year-old son. I started saving for his college account when he was born. Doesn't matter what the market's doing now. It's going to matter when he turns 18, when he needs that money. I can, if it took a dip, it took a dip. I actually put more money in there because that's a great time to buy.
Got it. Thank you again, Francisco, for your insight and taking the time to spend with us in this afternoon. If you could go ahead and share your contact information in the chat so that our participants can reach out to you for those resources you mentioned that you could share. Our participants, please note that we will be taking a 30-minute lunch break before the wellness breakout sessions that begin at 1:15 this afternoon. Feel free to take a break from your computer or join us for a speed networking to get to know some of your fellow conference participants. You should have received all of your links in your confirmation email, but they're also being posted in the chat box now if you need a copy of the links for speed networking or for the next breakout session. Krista is also sharing resources in the chat that you should check out as well. You'll have the Instagram account for FIU Young Alumni and for herself. I hope you all found this information as impactful as I did. Thank you for joining us. We'll see you for speed networking at 12:45 or the afternoon session at 1:15.
Bye, everyone.
Thank you.
Thanks.